The bear trap just snapped shut. For months, the whole financial world told you the same story about silver. $65 was the ceiling. 65 was the line in the sand. 65 was where the banks would show up with paper and push the price back down, because that is what they have done for years. Analysts treated it like a law of nature. Traders treated it like a brick wall. Commentators treated it like the market's final boss. And if you believed that story, today was supposed to end the same way. A spike, a slap, and then silence. A quick moment of excitement, followed by the familiar feeling that nothing ever changes in this market. But that is not what happened. What happened was a trap. Silver was shoved under the level everyone was watching. The shorts piled in, stops got triggered, weak hands got shaken out, and then the market did the one thing a trap always does. It reversed so violently that the people who thought they were in control became the fuel. If you are staring at the chart right now and you feel your stomach drop because you saw a spike and then a pullback, breathe. This is not a collapse. This is the retest. The ceiling is broken. The question now is whether we can defend the rubble, because once a bear trap closes, the game changes. It turns sellers into buyers, and it turns confidence into panic. Squeezed, trapped, done. Let me walk you through what you just watched and why it matters more than one day on a chart. First, the market had to remove the crowd's certainty. When everyone believes in the same level, that level becomes a target. Not because it is magical, but because liquidity lives there. Stops live there. Options live there. Leverage lives there. If you want to flip a market, you go hunting where the bodies are buried. That is why the trap starts with a shove. A sharp push under the level, a move designed to feel like confirmation. It is not subtle. It is meant to look like failure. It is meant to trigger the exact reactions people practice for months. Sell the breakdown, short the breakdown, get out before it gets worse. And for a brief moment, it works. The shorts step in with confidence. The headlines lean bearish. The panic selling creates a vacuum of bids. Price slips faster than it should. People call it manipulation. And honestly, they are not wrong. But the point is not the word. The point is the mechanic. The crowd is now leaning the wrong way. Then comes the snap. Price rockets back above the level, not slowly, not politely, but like a spring releasing. That is the door closing. The shorts who entered under the line are instantly trapped. The longs who got shaken out now have to chase. And the traders who were waiting for confirmation suddenly realize the confirmation already happened and they missed it. That is why a bear trap is not just a chart pattern. It is a positioning event. It changes who owns the trade. It transfers exposure from strong hands to weak hands, from patient holders to forced sellers, from confident shorts to panicked shorts. Now, to understand why that snap can be so violent, you have to understand the plumbing of this market, not the narratives, the machinery. Think about options, and think about the people who sell them. A market maker is the house in a casino. The house takes bets on both sides, and it tries to stay neutral. Around the most obvious strike in the world, 65, an ocean of call options built up. Those calls are bets that silver will be above that level. The house sold them, which means the house is short that upside. Here's where gamma comes in. Gamma is a measure of how fast the risk changes as the price moves. When silver sits near a heavily traded strike, a small move can force the house to hedge. That hedge is buying, not because they are bullish, but because they cannot afford to be wrong. Below 65, those calls barely matter. They are out of the money, they are background noise. At 65, they suddenly matter a lot, because they start behaving like real exposure. So as price climbs into that zone, the house has to buy futures or equivalent exposure to offset the calls it sold. That forced buying lifts the price. As the price lifts, the options become more sensitive, so the hedging requirement increases and the loop feeds on itself. This is why breakouts sometimes look like a teleport. It is not one whale pushing buttons. It is the structure of the market forcing the house to chase the price to keep its own risk under control. The house is not cheering for higher prices. The house is running from a fire. Now combine that with a trap, and you get something even more dangerous. Because the trap creates the wrong positioning right at the strike, and gamma turns that wrong positioning into a mechanical acceleration. And after the snap, you almost always get the same next scene. the pullback. This is where people start calling it a fake out. This is where nervous holders start wondering if they should have sold the top. This is where doom accounts start celebrating. But a pullback after a breakout is often healthy. It is a test. The market is asking one question: is 65 still a ceiling, or did it become a floor? If silver can return to that zone and keep finding buyers, the structure flips. Every slam becomes harder. Every attempt to push back under the level becomes more expensive. The old ceiling becomes a foundation. That is why I keep repeating the same phrase. We are not defending a number. We are defending the rubble. We are defending the idea that the wall is gone. So what do you watch next? You watch the defense. Do dips get bought quickly? Do we see price return to the level and hold without drama? Do we see the market stop feeling heavy? When that starts happening, it is not boring. It is the floor being poured. Now here is why this can turn into something much bigger than a few dollars. Gamma is a spark. The real fuel is the short side balance sheet. Silver is one of the most leveraged markets on earth. A futures contract represents 5,000 ounces. Huge stacks of those contracts exist at the same time. Most of them are rolled and netted, never delivered. But the price is set by that paper, which means the price is set by leverage and by the confidence that the system can deliver if it has to. Bullion banks and large commercial players have carried big short exposure for years. Some of it is hedging, some of it is market making, and some of it is simply the business model of keeping volatility contained while collecting spread and funding advantages. Either way, when price moves against a crowded short, the losses are not theoretical. They are real. They hit margin. They hit risk limits. They force decisions. A long can only lose what they put in. A short can lose far more because the market can rise without limit. That is why squeezes happen. Not because shorts are villains, but because crowded shorts are fragile. When the crowd is all leaning the same way, the smallest shove can knock them over. And once they start falling, they knock each other over too. Do the math in simple terms. $1 higher is $5,000 per contract. Multiply that by 10,000 contracts, and you are at $50 million. Multiply it by 20,000, and you are at $100 million. Now imagine a move of several dollars happening quickly in a market where liquidity disappears the moment everyone tries to do the same thing. That is how you get losses that feel like they arrived overnight. And when those losses hit, institutions do not calmly wait. They buy back risk, they trim, they reduce, they close. The problem is they cannot all do it at once because the act of buying to close is what pushes the price higher. The more they try to exit, the more they move the market against themselves. That is why squeezes go vertical. The exit is the squeeze. So in the days after a bear trap closes, watch for signs the short side is backing away. One clean tell is open interest. If price is rising while open interest is falling, that is often shorts closing, the casino buying back chips. If price rises with open interest exploding, the trade is getting more crowded, which can mean more fuel later. But it also means the next shake will be vicious, because more leverage is sitting on the same wire. And do not forget the oldest trick in the book. A wounded short will try to create one last flush. A sharp slam in a thin session, a scary headline, a sudden waterfall candle that exists mostly to create sellers. Why? Because the short needs liquidity to cover, and the easiest way to get liquidity is to scare people into handing it over. Now, even if the paper market is the battlefield, the real world decides how far this can go. Turn off the screen. Try to buy physical size. Try to get fast delivery. You enter a different universe. Spot is a headline. Street price is an invoice. On a screen, you see a number. In the real world, you hear questions. How fast do you need it? How much do you need? Are you willing to prepay? Are you willing to accept substitutes? Are you willing to wait? Industrial users do not care about your chart. They care about keeping factories running. If you need silver for electronics, solar, medical devices, the cost of stopping is bigger than the cost of paying a premium. So when supply gets tight, they pay up, quietly, immediately. That creates a shadow price, the real price paid to secure metal, even while the screen pretends everything is fine. You can see 65 on a chart while urgent buyers are effectively paying 70 once you include premium and availability. Maybe the dealer says, sure, we can quote you near spot, but it ships in weeks. Or you can pay up and we ship today. If you are a factory, you pay up. You do not argue. The cost of the metal is nothing compared to the cost of shutting down a line. This is also why retail premiums explode in these moments. People look at spot and they think they can buy at spot. Then they click and they see the real price. Out of stock, back order, ships later. Or the premium is so high it feels insulting. That is not just greed. It is the market telling you there is stress in the pipe. And when that gap widens, the paper market faces its most dangerous clause, cash settlement. Most unallocated and paper structures have language that says if delivery is disrupted, we can settle in cash. On paper, it sounds reasonable. In reality, it is the line between a functioning market and a market admitting it cannot perform. If the shadow price is higher than the screen price, the incentive is obvious. Why buy $70 metal to deliver when you can pay $65 in cash and call it done? It is cheaper to default, and the moment people believe cash settlement is likely, trust starts to die, because the whole point of owning metal was to step outside the currency machine. If cash settlement spreads, investors take that cash and rush into whatever physical they can get, which tightens supply, which raises premiums, which pushes more people out of paper. It becomes a loop, and loops are how markets break. The screen price loses authority. The street price becomes the real price. And when that happens, the market stops moving in polite increments. It gaps. So now we have layers stacked. The barrier broke. Gamma hedging added forced buying. The bear trap flipped positioning. The physical market is signaling the screen is not the full story. The math is pushing in one direction, and the supply chain is whispering the same thing. At this point, the market usually tests you with psychology. The biggest enemy you face is not a bank. It is vertigo. When an asset moves this fast, people get dizzy. You see gains and your brain screams. Take it before it disappears. The system relies on that reflex, not because you are weak, but because you are human. Expect volatility. You might see silver drop $3 in an hour, then rip 5 the next. You might see a scary overnight slam in thin liquidity. You might see the kind of candle that makes you want to close the app and swear off markets. That does not automatically mean the thesis is broken. Sometimes it is the last shake before the move extends, because shorts need liquidity and fear creates sellers. Your job is not to predict every candle. Your job is to know what would actually break the structure. If the old ceiling keeps acting like a floor, the structure is intact. If price loses that zone and cannot reclaim it, then you reassess. Until that changes, treat the noise as the price of admission for a trade that can actually matter. And if you need a stronger anchor than headlines, adjust for inflation. Nominal highs lie. Purchasing power is the real measure. People love to say silver is expensive because they remember an old number. But the dollar you use today is not the dollar from decades ago. When you translate past peaks into today's diluted currency, the move looks less like a bubble and more like a catch-up. The bubble is not silver, the bubble is the money. So the question becomes, when do you sell? The answer is you do not sell a hard asset for melting cash just to admire a bigger number. You sell to swap. You swap something that has repriced for something that has not. You use ratios, not emotions. You think like an allocator, not like a day trader. One map is the gold to silver ratio. When silver is hated, that ratio is high. When silver is squeezing, that ratio can compress hard. If it compresses into historically extreme territory, that can be a moment to trade some silver into gold without touching dollars, upgrading into something steadier while keeping your purchasing power inside the real asset world. Another map is silver versus real assets like land and housing. There have been moments where a surprisingly small amount of silver could buy a surprisingly large amount of real stuff. Today that relationship is stretched. If silver is repricing and the rest of the system is still priced in fantasy, the opportunity is not just the metal going up. It is the ratio changing. The exit is not a perfect top tick on a chart. The exit is a trade that improves your life and locks in real purchasing power. That is why the most dangerous mistake is selling, just because the candles got scary. If you sell because you feel motion sick, you are handing your position to the same players who needed you to panic. You are giving them your chips right when the party starts. Now bring it together. A bear trap is a mechanism. Price is pushed under a level to bait shorts and shake longs, then it snaps back and forces buying. Options plumbing can add fuel through gamma hedging. Short covering can add fuel through forced risk reduction. Physical tightness can add fuel through premiums and a shadow price that the screen does not want to admit. And the only thing that stops it early is a collapse in conviction. So if you see a pullback, do not automatically call it failure. Ask a better question. Are we defending the rubble? Are we building a floor where a ceiling used to be? Because if we are, then the trap already did its job. The shorts are squeezed, the crowd is trapped, the old game is done. The bear trap snapped shut. Now we find out how far the squeeze can go.